we're looking at it first from the employer side. And in Canada, stock options are not deductible. Many other places in the world they are. So if you have a Canadian company and you're giving stock options to basically on benefit of your foreign subsidiary, you may want to look at some tax planning. You may be able to pass some stock option benefits down and actually deduct it in the foreign country. So while they're not deductible in Canada, there may be some flexibility, some planning around that. So you want to talk to tax people and figure that out, because while we automatically assume if they're not deductible in Canada, they aren't deductible in the rest of the world, it's actually the reverse. They're deductible in most of the countries in the rest of the world. Canada is a bit of an exception there. When you're actually issuing exercising stock options for employees, you need to withhold tax and CPP. In past years, that was a little more uncertain. So CRA had a viewpoint, and they sort of let people exercise the options without having to pay the CPP and tax always. Now they've come out and said more strongly, yes, we're actually going to enforce that. So if you have an employee who's exercised a stock option, make sure the tax and the CPP has happened. Not EI, but tax and CPP. And along with that, anytime you have an employee, tax, CPP, you should be thinking T4 reporting slip, so by the end of the February period. And that's most of it from the employer's side. One thing to keep an eye on is employees. We often say, well, is somebody an employer or not? And which will be discussed more by Annalie down the road. But the definition of employee is a bit wider than we often presume. So sometimes an officer or corporate director may end up being caught in what we think of as being an employee. So for employees, stock option benefit gets included in your income in the year it's exercised, but it's kind of a nice thing, because if the actual stock option when it was issued was either at par or underwater, meaning you wouldn't knowingly exercise it at that point in time, and it's on a common share, generally speaking the case, and your arm's length from the corporation, I'll take a look at that in a second, then you get the 50% deduction. So while you're including 100% of the stock option benefit, so for example, my stock option I'm exercising, I pay 50 cents, it's trading at 60 cents, I'm going to be basically getting a benefit of that 10% spread. I'm not going to be paying tax on the whole 10%, I'm only going to be effectively paying tax on the 50% at the time it happens. So if it is, as I said, at par or underwater when it was initially issued, if it's a public company, or non-arm's length. Now, non-arm's length is not an accounting definition. Because you know how you're on financial statements, you have a lot of non-arm's length disclosure and such. Oftentimes that is actually considered arm's length for tax. So you want to take a look at that, and it's, as I said, it's a case-by-case, fact-by-fact basis, but it's actually a bit narrower for non-arm's length than you would expect. So the adjusted cost base in my example just ran through, where somebody's paid the 50 cents to exercise the stock option, got the stock at the 60 cents. My adjusted cost base now going forward would be 60 cents on it, because I've paid my 50 cents, I've paid my tax for my 10 cents, it's all based, and that's where I'm starting from at my platform going forward. So, presuming most of us hold our stock as capital property, if we have a couple of companies that we're doing work with, and we have, you know, a not extensive portfolio and such, when I eventually sell my stock, and I have either a capital gain or a capital loss, if I have a capital gain, so I'm running through my scenario again, 60 cents when I exercised it, I'm now going to sell it for 75 cents. That 15% increase is going to be my capital gain. On my tax return, I have a taxable capital gain at 50% of that. So I'm going to have a taxable capital gain of roughly 7.5 cents per share. That gets reported in my income the year I sell it. If there's a capital loss, again, so let's say by 60 cents, I now, unfortunately, it didn't do so well. So it sold it at 55 cents. I have a 5-cent loss per share. Okay, I would have an allowable capital loss at half, so 2.5 cents. The problem is, and we'll go into a couple examples later, allowable capital losses do not offset normal income. So unless you have a capital gain to use against it, it might be sitting on your, basically in your books, so to speak, for a while. So you'll be able to use it down the road, but you would need a capital gain to offset it, not just normal income. So we'll run through a couple of examples so you can see why this really matters sometimes. A number of times you've seen cash out plans. which were quite common. CRA's now changed how we look at the cash out plan. So in the past, it was great. So you had the stock option, and instead of exercising the stock option and then selling the share immediately, the company would just say, hey, we'll give you cash for that. Okay. And for many years, CRA said, great, you're giving them cash for that. The company can deduct it. The employee has all the wonderful taxable benefits on it, gets it at 50%. It's wonderful. It's a little too wonderful. CRA has come out and said, well, you don't get both sides. So generally speaking with the cash out plan, it's viewed as being normal employment income to the employee, and the corporation deducts it. However, if the employer wants to give up that deduction and files the right elections and all that stuff, it can be treated as a normal stock option plan, if that makes sense. So you don't get both things, you get one or the other. Either it's deductible to the employer, or the employee gets a nice 50% tax rate effectively on it. We've seen a number of people setting up structures similar to this. So you have the public corporation, you have, I'm going to say, an incorporated management company, or director corporation, independent contractor corporation, okay? And then you have an employee of that corporation. So this is a fairly common structure that will be used. So if you're doing this, I'm just going to talk a bit about how the structure works and a bit about some pitfalls we see on it. Okay. So first of all, what happens is the public company issues a stock option and pays it to the investment corp. Okay. The IC corp basically has that as normal income. So they have to do the right remittances. They're GST-able, they report all the value of that stock option, which oftentimes isn't that much, in their income. But all that happens properly. The thing is, this stock option that's being pushed up here in this situation needs to be for past services. Okay. And past services are not presumed to happen. You really need that written and supported that it is actually a past service. CRA assumes it's for current or future services. They do not assume it's for past services. So it's quite well documented if you're going to go that route. Okay. So now we've moved our stock option up to IC Corp. We've done it pretty quickly, so there's probably not much value on that. Then the IC Corp then pays their employee and pays them by way, in this case, of an issuance of the stock option. So they pushes the stock option now up to the employee. Again, in this case, it's normal income to the employee of IC Corp. So we need to make sure we're remitting our CPP and our tax. I'm going to assume it's non-arm's length so we don't get do EI. The employee has a stock option in their hands. Probably paid very little tax to get it there, because generally speaking, when they're initially issued, when they're underwater at par, there's not a lot of value there. They're now holding this. When they actually exercise it, there is not going to be a tax at that point in time. There's not going to be any tax until they actually sell the share, and all of it is treated as a capital gain or capital loss. We don't have the employment income piece of it, so a capital loss could offset it, which is nice. There's a bit more flexibility often with this arrangement. So we see people doing this, which is not a bad strategy. If you're going to do it, talk to somebody first, because a couple of pitfalls we've seen is a lot of public companies don't actually let you pass the stock options on. So you've put the stock options up to IC Corp, you can't get them through IC Corp up to the employee. Okay, so that's one that we've seen. Again, documentation on the fact is for past services and proper GST being charged and proper remittances happening. So everything is happening above the board, and it's just really the documentation on that to happen and make it work. So it's good to talk to somebody at the time of planning versus if you end up with a CRA audit, it always takes a bit more time than you really want. And that's the walkthrough. So it's a very detailed slide. That's what I just talked to you about. So it's there if you need notes for later. For an independent consultant, it's not an employee. Okay, as soon as you're not an employee, you are going to report everything as if it's basic business income. So you're not going to be playing around and doing a 50% stock option benefits and such. It's just normal income to the employee. the independent consultant. Again, same situation. Nothing happens when you actually exercise a stock option. It's not till you sell the shares down the road that you actually end up having any tax impact. And then again, the taxable capital gain or the taxable capital loss would happen. We get a lot of questions with regards to non-resident employees. Now, if you have a non-resident employee who does no work and no services in Canada, Canada doesn't say to you, we need you to pay tax. So as a result, no service in Canada, not subject to Canadian tax on any of the stock option benefits. So that's it. Now, if they start coming up to Canada more and more, so you start, let's say you have a subsidiary in Mexico, you've been working with this person for a long time, and you start bringing them up into Canada, then you want to start looking at that relationship again. So just, that's kind of when the tipping point happens, when you start bringing them into Canada to do work and services in Canada. Up until then, you're in good shape. Now, we have two examples. These are more, I'm going to say, for your future referral, and I'm just going to run through the concepts of them here. In both cases, the facts are fairly similar, okay? I'm going to say there's 100,000 of stock options that we've received as an employee. The price of exercise is 50 cents. They were issued underwater, okay? Common shares, arm's length, all the good stuff. I'm going to get the stock option treatment. I'm going to get the 50% treatment. In January of the year, I exercised when I was trading at 60 cents. Okay, great. Okay, I have my 50 to 60 cent, my 10 cent spread you see there. I'm going to be paying tax on it, but I'm going to be paying tax on it effectively at a 50% rate. Now, when I sell them at 75 cents, I'm like, oh, great, I have another 15 cents of gain. Okay, my marginal tax rate is 45%. It's a bit high for this year. It's more accurate for next year, for the next 2 years where our tax rates are increasing. And this is a whole bunch of calculations. You can put numbers in and play with it. Ignore it beyond that for this presentation. And at the end of the day, our shares were at 75 cents a share, 100,000 shares. We're going to get proceeds of 75,000. What do we put into it? Well, we purchased the shares. Stock options were 50 cents a share at 50,000. And when you work the tax out, it turns out to be about 5,600. So we end up with cash in our pocket as a result of this, basically of 19,000. Great, we're happy, we go home. Next example is not quite so cheery. Next example, we have our stock options again, 50 cents. We exercise them at 60 cents. Down the road, we sell them at 51 cents. Okay, the marginal tax rate 45. So when I'm looking at this, I go, okay, well, it's not too bad. I pay 50 cents a share. When I'm selling them, I get 51 cents a share. Okay, I'm ahead of the money. I'm doing not too badly. That's my, like, I don't know about you guys, that's my initial take on it. When you just look at it and you go, oh, that's not too bad. The tax makes it not quite that nice. So I'm going to run through, again, I'm jumping past the next slide, so you can just put your numbers in and calculations in if you ever need to use it. Okay. I'm going to go through and sell my shares now. And this is going to come down to the concept of I have lost money from my 60 cent exercise price to my 51 cent selling price. I have a capital loss. But I was paying tax on income from my 50 cents to my 60 cents. So what ends up happening, I sell my shares, 51 cents a share, 100,000 shares, my $51,000. I paid 50,000 again, so I'm looking pretty good. I have my $1,000 swing. My tax, unfortunately, is enough to make it a bad situation, a bad investment choice, potentially. However, in my pocket, on the other hand, I have an allowable capital loss at the bottom of $4,500. And this is what I haven't been able to use to offset my income in the year. So down the road, it carries forward indefinitely. Down the road, when I have capital gains, I will be able to use it. So it's not as bleak as it sounds. It just means in that year, if I don't have capital gains to offset, we're a little bit out of the money. So that's effectively what happens. Now, if anybody remembers the stock bubble and .coms and such, this happened, but even more dire. So people ended up very, very, very bad situations with like a lot of cash out. What the Canada Revenue Agency did a year or two ago, and it runs until 2014, for people who did an election to do with it, so they ended up really kind of pretty much having to go bankrupt as a result. The CRA said basically, hey, you can always just send us all your proceeds. So you could send in this situation, more or less the $51,000. Okay, and then for some people that was a much better situation. We don't want to be doing that, ideally speaking. So just watch the investment on that. Okay.